Naturally, when markets pull back, everyone looks for a headline explanation. People want a simple story. So the narrative that quickly started spreading was Japan, the yen carry trade, and the upcoming rate hike. Yes, Japan does have a rate hike scheduled for next Friday, December 19th. And yes, there's roughly an 83% probability that hike happens. But here's the reality that traders need to understand. The market already knows this. It's already priced in. If something is expected, it rarely shocks the market. What actually matters is what comes next, and more specifically, how hawkish global central banks remain after that decision. As we move into next week, the SPY is setting up at a very critical point. Over the last several sessions, we tested the 688 area multiple times and failed each time. We pushed into it, got rejected, pulled back, tried again, and once again got rejected at the exact same level. That is not noise. That is structure. When price fails twice at the same level, especially after a long run higher, that forms what we call a double top. And double tops are not just chart patterns. They are psychological signals. They tell you that buyers are losing conviction at higher prices. Now here's where next week becomes extremely important. If we start Monday trading below 681, the conversation changes entirely. At that point, it's no longer about consolidation or chop. The market will begin to assume that the upside move is on pause, and when that assumption sets in, buyers stop chasing and instead wait for lower prices. That shift in mindset is often what accelerates downside moves. Adding fuel to this fire were comments from Fed Governor Goolsbee earlier today. He went on CNBC and said something that most people heard but didn't fully process. He said it has been 4.5 years since the market has seen sustained 2% inflation. While the Fed believes inflation is cooling, he openly admitted that they don't yet have proof. And that word proof is critical. Without proof, the Fed has no reason to rush rate cuts. Higher for longer remains the default stance. This is why, even though the Fed sounded dovish last Wednesday, I've continued to say that the underlying posture was still hawkish. Tone and action are two different things. And when even one of the more historically dovish Fed members is saying there's no proof inflation is under control, the market listens. It may not react immediately, but it processes that information. Now, here's what makes this environment tricky. Nobody wants to be the first person to sell growth stocks. Big tech has been an absolute powerhouse through 2023, 2024, and into 2025. These stocks have rewarded patience, and there's no definitive signal that the bull market is over. But markets don't move in straight lines forever. What we're seeing right now isn't panic selling, it's hedging, profit-taking, and rotation. And those phases often precede pullbacks that reset price before the next leg higher. When we look at the SPY technically, there are several warning signs lining up. Price has been drifting higher on declining volume. Momentum indicators like RSI and MACD have been showing bearish divergence, meaning momentum has been weakening even as price pushed to new highs. This combination divergence plus rejection at a double top is something you almost always see before a meaningful pullback. If 681 breaks with conviction, the structure opens the door toward the 658 region and potentially lower if sellers gain control. Stepping out to a higher time frame, the monthly chart tells an even more interesting story. The 9 EMA on the monthly chart has historically acted like a magnet for price. Over long periods of time, price almost always comes back to test it. We haven't tested that level in quite a while, and historically, those gaps tend to close every 9 to 10 months. We're now right in that window. Combine that with a potential high time frame bearish candle structure, and suddenly the risk-reward begins to favor caution rather than aggression. But here's the part many traders miss. When markets become choppy or corrective, opportunities don't disappear, they rotate. Money doesn't vanish, it moves. And this is where being selective becomes far more important than being bullish or bearish on everything. One of the names I've been talking about recently is Netflix. This stock has taken a beating, down roughly 28%, not because the company suddenly became bad, but because of uncertainty. Talks around potential acquisitions, concerns about dilution, and financial restructuring have weighed heavily on the stock. But when you step back and look at the fundamentals, Netflix actually executed extremely well throughout the year. Earnings were strong. The business didn't break. On Wednesday, I specifically said that the selling pressure looked like it was nearing exhaustion, as long as price could hold above $93. I said Thursday and Friday were the days to watch, and that if we stayed above that level, we should start to see green candles. That's exactly what happened. The stock pushed up toward $97, and that move tells us something important. Sellers are stepping aside, and shorts are beginning to cover. This doesn't mean Netflix goes straight up from here. No stock ever does. There will be red days, pullbacks, and pauses along the way. But from a structural perspective, this looks like the early stages of a reversal rather than a dead cat bounce. In broader market pullbacks, beaten down leaders often find bids first, especially when the selling was driven more by uncertainty than by deteriorating fundamentals. From here, I'm watching higher time frame targets around 101 and then potentially 108 as we move into late December or early January. Those levels line up with key Fibonacci retracements and prior areas of interest. As long as price continues to respect higher lows, the path of least resistance remains higher for this particular name, even if the broader market stays choppy. So when we zoom out and tie all of this together, the message is actually very clear. The SPY is at a decision point, and Monday matters. The 681 level is the line in the sand. Above it, the market can still attempt stabilization. Below it, risk increases quickly and downside targets come into play. At the same time, selective opportunities are beginning to emerge for traders who are patient, disciplined, and focused on structure rather than emotion. This is Wall Street. It's not about chasing every green candle or panicking on every red one. It's about understanding where you are in the cycle, respecting key levels, and letting the market show its hand before you make aggressive bets. If you do that, you put yourself in a position not just to survive volatility, but to take advantage of it when the next opportunity presents itself.